Good afternoon. Welcome to the Global Interdependence Center's Executive Briefing. I'm Don Rissmiller, your host and GIC Chairman Emeritus. This is the 11th program in our Analyzing Pandemic series. Today, we will explore economic responses to the pandemic, as well as the predicted recovery and what the economy will look like post-COVID-19. I am pleased to announce that today's event is part of the David R. Kotak Global Healthcare Series. On behalf of everyone at the GIC, I want to express our appreciation and thanks to David for his generosity. As a reminder, this event is being recorded and the replay and the slides will be available to GIC members only through the GIC website. Joining us today are Greene and Philipp Carlsson-Szlezak. Megan has been a leading voice in global macroeconomics for the past 15 years. She is currently a senior fellow at the Harvard Kennedy School. She writes a monthly column on global economics for the Financial Times and has written frequently for Politico, Bloomberg View, and Foreign Affairs. Philipp is BCG's chief economist and a managing director and partner in the firm's New York office. He leads the Center for Macroeconomics at the BCG Henderson Institute. Philipp's research covers structural, cyclical, and firm-level themes, and he advises clients on both strategic and tactical macro questions. Megan's presentation today is titled The Response, the Recovery, and the Other Side. Megan, please take it away.
Yeah, thanks, Don, for that introduction, and thanks to the GIC for inviting me to come and speak. I wanted to talk about, as Don just said, the response, the recovery, and what the world and our economies are going to look like once the dust has settled. Taking a global perspective, first I'm going to start off by just saying that economic forecasting is hard. It's hard at the best of times, but there is no line in our macroeconomic models for a pandemic or for a lockdown or a reopening. And so economists really are and have been grasping in the dark in terms of economic forecasts. Just to give you a sense of that, Bloomberg does a survey of professional forecasters, economic forecasters, and for this quarter that we're in right now, Q2, which we're most of the way through actually, annualized, there's a range from a contraction by 7% to a contraction by 65%. Now that's for a quarter that we're almost all the way through. For next quarter, actually, the range is from a contraction of 5% to growth of 65%. These are the biggest ranges I've ever seen in terms of economic forecasts, and it's just to highlight how incredibly uncertain things are. So as you know, in normal times, economists look at all these monthly indicators for the most part to figure out what's going on in the economy. By the time these monthly indicators come out, they're already massively outdated. And so we economists have turned to a whole bunch of alternative data to try to figure out what's going on, where the bottom is, whether the economy is still in quicksand or not. So we're looking at things like raw steel production, gasoline demand, open table bookings is a new one, TSA data on how many people are going through airport security, consumer confidence metrics that are a bit more frequent as well. And when we look at these, we actually see that there seems to be a bottom. If we're not fully there yet, and I think we are, to be honest, we at least we can see it. So we're not on quicksand anymore. Raw steel production is still falling, but at much slower rates than it has been falling, and that continues to decelerate. You know, consumer confidence, according to the Bloomberg Comfort Index, seems to be stabilizing at really low levels. Gasoline demand has really bounced, actually, so that's picked up pretty significantly. More people are making open table bookings. That's as states open up. More people are flying. I will point out that if you're looking in percentage terms, some of this data looks absolutely phenomenal, and that's just going to continue to be the case, so don't be confused by that. TSA data shows about 150% increase on travelers from last week. That doesn't mean that all of a sudden everyone's flying. It's just from a really incredibly low base, and that will feed through into the GDP data. So in Q3, we'll probably have the best growth that we've ever seen from an incredibly low base, and that will be politicized. in an election year. So that's worth pointing out. But the thing about these high frequency indicators is they give us a sense of where we are. They don't give us much of a sense of where we're going. And for that, there's actually one indicator that I think might be illuminating, and that's put together by my colleagues Raj Chetty et al. At Harvard. And they've basically gotten all this data largely from the private sector. They've cleaned it, they've put it up online for free. It's called Opportunity Insights. And they show a lot of the spending data using credit and debit card information. And it shows that actually for states that opened up a long time ago, spending looks identical to spending in states that are just opening up now. So spending in Georgia, one of the first states to reopen, looks identical to that in New York and Massachusetts, which have really only just started to reopen. And I highlight that and say that's interesting because it suggests that policy isn't really the impediment in terms of demand at this point. It's more people's confidence in terms of going out and spending and living life as close to normal as possible. And it suggests that even though in those states where you can go to bars and restaurants, people aren't really doing that. And I think that suggests that this is going to be a pretty long, hard slog to get back to anything, like normal, and also for the economy to return to where it was in February, for example. The jobs data came out last Friday, and jobless claims come out every week. They've shown that, the labor market is improving, that a lot of our policy to try to help out those who are being laid off have really succeeded, particularly the PPP program. And there was going to be a big bounce at some point. It's much easier to add the first 20% of jobs back than to add the last 20% of jobs back. And so I think we will get a rebound that will look a bit like a V-shaped recovery in the very short term, but actually that won't continue apace, and it's going to end up being a pretty long, hard slog. So I'd say it'll look more like a Nike swoosh with maybe a zigzag on the back end. As we try to generate demand and return to normal. Now, how are we going to pay for all of this? Because, of course, every major economy has thrown tons of money at this problem in terms of monetary and fiscal stimulus. First of all, I hate that this is a question. I don't think it's an appropriate one at this point. But secondly, I think, it is creeping up more and more. It's a bit like being in the middle of a war and asking, how are we going to pay for this? Generally, you just need to win the war first, and then you figure it out. But given that politicians are already starting to ask about this, particularly in the US, a number of Republicans have come out, it's worth addressing this question. And the very obvious answer for major developed economies to issue their own currency is deficit financing. Borrowing costs are incredibly low. Central banks have said they'll be low for the foreseeable future. So the thing to do is clearly to just borrow the money. But as I said, the politics is starting to push against that, and that's in line with what we saw after the global financial crisis as well. After 2008, 2009, you had a few rounds of fiscal stimulus measures, and policymakers really thought, well, we'll just get this stuff through, and then we'll kind of do the rest and perfect it later. And by the time later came, there wasn't actually much appetite to pass much more. I think we're starting to see that now as well. So I do think we'll get a fourth fiscal stimulus bill, but I think it's going to be hard beyond that for politicians to align behind more spending. So deficit spending is the no-brainer, obvious answer. Another option, if the politics don't line up behind that, is helicopter money. And helicopter money is essentially a concept Milton Friedman brought up, and Ben Bernanke more recently has kind of popularized it. The idea is that a central bank prints a bunch of money, sticks it in a helicopter, flies out over a town and drops it on people. And it's a permanent drop, people get to spend it, and that creates a bunch of demand. There are a bunch of problems with helicopter money. One is that central banks in most major developed economies are meant to be independent. And so if they're printing money and then essentially giving it to the government in many cases to give out, then that really impinges on their independence. That being said, if you believe that central banks are going to be unable to shrink their balance sheets, we're already doing helicopter money in some ways. And if you don't believe that, then if you look at some programs like the TLTROs in Europe, or sort of funding for lending schemes that they've done in the UK, those are direct subsidies to the banks. That is a form of helicopter money. So that could be one way to pay for this if we end up having to do it. I'm constantly asked if we're doing MMT now. MMT it's modern monetary theory. It's not really anything you do. It's more of a theory about money, and there is a lot that MMT gets right. I think they get it right that actually a government doesn't have to raise the money before it spends it. They can spend it and then figure it out how to raise the money later. So it's not relying on tax receipts for spending at all. I think that's right. I think that MMT is right that you can spend a lot and the deficit isn't really a constraint, it's inflation. I think that's also right. And we've lived in a world for a decade now where we haven't had much inflation. I don't think it's something we need to worry about. And I will die on this hill. It's going to be difficult for us to generate runaway inflation in this environment. What MMT I don't think quite gets right is how to deal with inflation. They say instead of central banks hiking, lowering rates, actually just raise and lower taxes. But taxes are an inherently political process, so I think that that's quite problematic. But are we doing MMT insofar as it's something you do? To some degree, maybe a little bit, in that we're just deficit spending now. Now, I mentioned deficit spending is the top choice for developed countries who issue their own currency. We are facing into the biggest debt crisis that we've seen since the 1980s in emerging markets. And for emerging markets, deficit financing is just not an option. Emerging markets have seen both borrowing costs rise and their currencies tank. And so they've been really hamstrung in terms of the stimulus measures that they can possibly apply. So deficit financing is off the table. What they're going to need is aid. They've gotten a bit of aid. The G20 has essentially called for a debt moratorium, so they're not paying debt servicing costs during this crisis to the official sector. Private investors, however, haven't gone along with that, and that's a big problem because a lot of these countries owe a lot of money to private creditors. So private creditors are sitting on their debt. One day, at some point, there's going to need to be a bunch of debt relief. The problem with that is that, it's impossible to do a debt sustainability analysis right now, where, as I say, we're looking at things like open table bookings in the developed world, at least, to try to figure out where we are. So it's just too hard to forecast to figure out how sustainable an emerging market country's debt burden is. So that's a bit further off. One thing is really clear, though, they're going to need aid. It's going to need to be more than what they've got now. If we can't do debt relief now, we're going to have to provide more loans. And so the IMF has got to beef up its firepower. It has been mooted that the IMF can issue more SDRs. It's unclear how much that will raise, probably not that much. But unbeknownst to most people, the IMF can actually issue debt in the capital markets. So the IMF can borrow. And that could be incredibly powerful. It's never done it before. If it borrowed in US dollars, it would need the US's support, and that's not just a small wrinkle. That could be difficult. But I think we need to think creatively about how the IMF can actually raise much more money so that it can increase its firepower. I've talked about kind of the difficulties we have in forecasting, how we're going to pay for this, and I just want to finish up my comments by looking into what the world is going to look like once the dust settles. It's too early to say definitively in many ways, but there are a few things we know. One is that, protectionism is here to stay. Regardless of the US elections, protectionism tends to be a Democratic ideal, not a Republican one. So it doesn't matter who's in the White House, I think we'll have more protectionism. Along with that, I think we'll also have an industrial policy. Now, industrial policy has been an anathema in the US for decades, and all of a sudden we're finding there's bipartisan support for it. And so there are discussions about creating incentives for companies to reshore. I think global supply chains, we're already shifting, and a lot of things that we will see at the end of this were already happening, but the coronavirus crisis has really accelerated it. If we don't see companies reshore, we'll see them probably regionalize. And if you think about it, firms have had global supply chains in part because that was the most efficient for them. So if we have regionalized supply chains, that will probably not be as efficient, will probably be a bit more expensive, and so that will eat into corporate profits. So I think that's one thing we can expect. How we work, I think, will be forever changed. We've always had, not always, but for a long time, we've had the technology to work from home a lot, and we just haven't really done it. Now we've all been forced to, and I think for a lot of us, we've discovered in some cases we get a lot more done at home. In other cases, the technology actually works better than real life. So I have to teach at Harvard, and in some ways, moderating conversations when people write in questions, you can group them and you can kind of lay out a theme. It works much better in many ways. More people attend these things because all you have to do is sign in rather than go to a lecture hall. So I think that, working from home is going to be a new trend. We won't all work from home all the time, but I think we'll do much more of it. That has implications for commercial real estate for sure. Companies won't need to have so much property. Their offices can be smaller, people can rotate in their offices. But also it means, I don't have to be sitting in Boston to teach at Harvard. I can actually be anywhere. So people won't have to be in major cities. They won't even have to be in their own countries. I think that will be an increasing trend as well. I mentioned, this debate about how we're going to pay for this war. And I think that, we don't need to worry about it now. If inflation remains fairly low and we return to potential growth at some point, now potential growth might be a bit lower, then actually our nominal GDP growth should be well above borrowing costs. And so our debt burden should shrink on its own volition. That being said, I think this issue will be politicized, and that I think governments, not just in the US, but globally, will end up increasing taxes. I think they're going to try to pluck tax revenues from every goose they can find. And so in some sense, that could mean we could get a carbon tax, a digital tax, these ideas that never quite got across the finish line. They might finally find some traction. In the US and in much of Europe, I think the feeling is that income taxes are probably high enough, so the burden will probably fall on the corporate side, so there will be higher corporate taxes, I believe. In that sense, the state will be playing a much bigger role in our lives. And that's sort of the pernicious side of this. I think another factor is that the state, we'll all accept the state playing a larger role in our lives. And so as we've experienced this crisis, the most vulnerable have been hit certainly the hardest and the fastest. If you look at our labor force in the US, it's the hourly services workers who were hit immediately. They never really experienced any wage growth over the past decade, so they never quite got back up on their feet after the last financial crisis, and now have been knocked back off pretty immediately. And so it has started discussions about whether we need to actually protect the most vulnerable in society better. I think it's interesting that the Biden campaign has taken on some of Bernie Sanders's advisors, Stephanie Kelton, who's the poster child for MMT at this point. She's one of the advisors, so it's interesting that the Biden campaign has sort of embraced further left-wing thinkers to try to come up with ideas about how to protect the most vulnerable. And there's a great precedent for this, actually, if you look at world wars in particular. After world wars in the UK, we ended up with the National Health Services, council housing. In the US, after the Great Depression, we ended up with Social Security. So I do think that there is a chance that, a positive to having a bigger role for the state in our lives is that we do figure out some way to actually protect those who have been most vulnerable, and we've figured out how to address inequality, which was a major issue in the US coming into this crisis, will only be exacerbated by this crisis, not only because of what I said about who exactly was hit in the labor force, but also because other underlying driving trends of inequality, income inequality in particular in the US, which includes, increased digitalization, increased market concentration. Those are all only going to be exacerbated by this crisis. So that is an issue that will be worse, and hopefully we'll come up with some way to address it as we go through this crisis. I'll finish my remarks there.
Okay, thank you very much for those insightful remarks, Megan. We'll ask you to stay and join us after. Now we'll turn the discussion over to Philip. Philip's presentation will be discussing what the post-COVID economy will look like. So Philip, please take it away.
Thank you, Don, and thank you to the GIC for inviting me today. I believe we had a few slides that we wanted to throw on. I presume they're coming up. But essentially, let me take a look at forecasting from a bigger angle of what is the post-COVID world going to look like. And if we go to the first slide here, just a brief entry remark on forecasting, which, you know, in the best of times doesn't work. But I think a picture like this reminds us of why it can't work, quite simply because forecasting models are reliant on past empirical experience. Essentially, what we feed into the models is the basis of forecasting, and we have never fed an economic model with a quarterly annualized contraction of 40%. So it can't possibly give us something that's reliable, and hence in March, you saw the median broker forecast collapse by, 200 basis points by the hour some days. And so I think the point is forecasting to one side. Let's think about it a little more conceptually. I think the big risk in the situation is that the intensity is all encompassing. And it is tempting to think that because the intensity is so strong, the legacy must also be the worst kind. So in my conversations, which are boardroom conversations in the largest companies around the world, I see a lot of fear about the legacy, and we're drawing off in a straight line from just how bad this is in terms of unemployment, in terms of consumption contraction, etc., to what the future must be like. Now, let me move to the next slide, and I just want to give you three angles of how to think about the post-COVID world. I think there are three things to consider shown here. The first one on the left is the question of big foundational cracks in the operating system of the US economy or the global economy, basically macro regime risk. How does the world work? And does COVID have the power to crack that operating model? So when people speak about a new Great Depression, when they think about a currency crisis, even for the dollar, sovereign debt crises, these strike at the heart of the good macro regime of the last 30 years, price stability, etc. And they're quite dominant in some conversations. So it's important to look at that from a very foundational perspective. In the middle, I'm going to remark briefly on what is very absolutely certainly going to happen, that we have some structural damage. So the question of the shape or the shock geometry in the recovery, how are we going to see those recovery paths? That's sort of the middle column here, the second pillar. And then the third one has to do with behavioral change. So the economy is going to change because some of the adaptations we see to COVID-19 are going to be permanent. And that's going to put pressure on some business models, but it's also going to create opportunity for other business models or other sectors. And so there's a question of whether particularly the services economy can be cracked open in terms of a productivity growth laggard, and whether there is even a silver lining if we manage to speed up some of the lagging indicators there. Now, diving into the first pillar or vertical here, the big macro regime question. Let me start with a reminder on the next page of what the last 30 years pre-COVID actually gave us. You can skip that one, please. Thank you. Here is a reminder of what the world was. I like to call it the growth returns paradox. So here's on the left, you see the US growth experience, a deceleration over many, many years. But then we have to ask ourselves, how could it be that equity returns were so strong over that same window? So on the right-hand side, I show you a real return decomposition over the same window, and the dotted line is the average return since 1900. We've lived comfortably above the long-run average return. How is that possible if growth decelerated so badly as shown on the left? So I refer to this as good macro, a constellation of structural tailwinds that have been almost too good to be true. Here I just showed two. Look at the multiple change, look at the real EPS growth. Multiple change is predominantly a function of the anchored inflation regime that has taken hold since the mid-80s. Paul Volcker setting us on a long-term downtrend, not just in levels of inflation, but also the volatility of inflation. That has allowed long rates to come down, risk premia to fall, discount rates to fall, and multiples to secularly expand as shown here. So there's a regime story going on that is underpinning everything that was good the last 30 years. And a lot of things were very, very good the last 30 years. Real EPS growth in the middle even in the face of falling domestic growth, is the story of global value chains. It is the story of China's accession to the WTO. And so it allowed not just only the disintermediation of production, squeezing out production costs, but also selling into these faster growing markets. Now, those are just two components of the, what I like to call good macro regime. If you go to the next page, and I'm not going to go through every line there, but I want to give you a bird's eye view of good macro the last 30 years. You have essentially three layers here. The first bucket is real economy regimes. The second in the middle is financial regimes horizontally. And the last one is institutional. And then the color codings are these tailwinds or headwinds over the last 30 years? And what's my expectation for the next 10? So just at a high level, I already mentioned global value chains. If we're honest, they had already stumbled before COVID. First in 2008, and then with America First, with Donald Trump's election. So there's a lot of headwinds there already, particularly also with the trade architecture, where the trade architecture was concerned. I mentioned the inflation regime. I put a little star there on the slide. The inflation regime is solidly anchored. I can come back to this, but I see no way for there to be an inflation problem in the US economy in the near and medium and even longer term. Now, what I'm trying to say here overall is we need to look at the post-COVID world from a structural perspective in terms of those tailwinds that have been structurally entrenched the last 30 years. And if I look at it hard and in detailed fashion, if you go to the next page, here is my view of what's going to change in terms of good macro. The answer is fairly little. In the real economy bucket, there were some headwinds, the global value chains that has stumbled. COVID is going to accelerate this. It's not a new trajectory, but there is, by and large, we are not introducing any new trajectories in the real economy regimes. Potential growth, I do not believe is going to be impacted. The real moderation of real economic volatility is going to stay with us. Long cycles are going to stay with us. These are long, deep-seated structural shifts that COVID can't easily dislodge. But most importantly, in the financial middle horizontal here, you have lots of concerns around inflation. Again, I don't share those at all. I believe the sovereign debt situation, particularly for the United States, is extremely favorable. COVID actually makes debt capacity more favorable for the US. The R-G regime, so nominal rates are lower than nominal growth. That is a structurally entrenched regime. It just got better, so to speak. So the idea of a US sovereign debt crisis strikes me as rather alien. I think where we see the most flux structurally from COVID-19 is in the institutional domain. But again, here it's important to say these were accelerating forces that are unfolding now. All of this pre-existed. The dismantling of the trade architecture was a pre-COVID story, and the drifting apart of the technology order, or sort of decoupling of two technology platforms, was already in the making. And so we see accelerating forces here. Now, I think this is sort of a bird's eye view of good macro. I think good macro is this constellation of structural tailwinds. By and large, I think it's going to persist. We're going to see some accelerating regime decay, but that again is an accelerating force of pre-existing headwinds. If you move forward, I think we probably want to skip a few slides. Yeah, we can skip the R-G I mentioned. We can skip, maybe here briefly, bond equity correlation is an important point. Bond equity correlation is so deeply negatively entrenched in the US. You see that on the left by decade. We've spent 20 years in negative territory. It's not just that we are in negative territory, we're so deeply in negative territory on bond equity correlation. So in risk-off periods like the one we have now, we see the full benefits of that. I think all that flies in the face of a dollar problem. All that flies in the face of other sovereign debt concerns. To me, those fears don't ring true. If you move on, please. Not sure what else is there. Can move on. I mentioned inflation. Let's see, maybe we can move to the next chapter. Global value chains we mentioned, move to the next one. Thank you. So let's move into the second vertical that I mentioned, which is more to do with the path or the shock geometry of how all this unfolds. And so much has been said about shock geometry, an alphabet soup of shapes, etc. Let me maybe briefly just touch a few points that I think are important in this somewhat confusing debate. If you go to the next page, quick reminder of how it's played out in 2008. I think the crux here, when I look at Canada, the US, and Greece, is if you compare Canada and the US, all that it comes down to is, do you have damage to capital formation? Does the capital stock take damage in the crisis? And what happened in Canada is that you avoided the banking crisis, so credit intermediation wasn't disrupted, the capital stock didn't take the same hit, and so you come back to your old growth path and your old growth rate, and so you get that V there. In the middle, this is actually a U in my definition. In the US, you get the hit to the capital stock because the banking crisis disrupts credit intermediation. You miss a whole window of capital stock growth. And so importantly, your slope of the line is the same as your prior trend, but you never make it back to your old trend path. So you have a downshift, but your growth model isn't broken in that sense. And then Greece is sort of the worst of the two combinations. You lose the level and you lose the slope. And I think that's to be ruled out in terms of COVID, because for that, the crisis needs to be recurring. And I don't think it's plausible or reasonable to say that you will never find a vaccine, that you will have recurring shocks year after year after year. So I think I'm deselecting the right, and we need to focus on V versus U. Let me go to the next page and just show you how I think about it more technically. I think in most client conversations, we need to frame it more in terms of NPV of a shock. So what is the NPV effect of that kind of shock? The way to get to the bottom of this, obviously it's hard, but what we need to watch is, again, is the level down and is the slope of the growth path different as you move out of the crisis. And that really comes down, there are two ways of getting there. One is a financial crisis, and the other because of credit intermediation, the capital stock I mentioned, and the other one is quite simply such a long extended real economy freeze that you have the same effect as from a banking crisis, namely firms are not investing. And it's not just that CapEx is delayed, it's that it's canceled and new plans aren't being made for future CapEx. Now, so for me, the battle of V versus U is really a policy battle. It's a question of how much can policy contain the damage to capital stock growth. The battle is ongoing. There's no way of saying it's going this or that way at this point. We can look at some data, I'll do that shortly. But in the end, it comes down to that damage to CapEx and capital formation. Now, if I look at some of the indicators there, and I think we have that on the next page, I think the fear that was clearly there in March was, can you get a banking crisis on top of this? And if you look at the first column there, I think as of now, we can deselect that. We have nothing like the LIBOR spreads during the global financial crisis. If you look at commercial paper, both financial, non-financial, there's nothing there that looks like a lot of stress. Why? In part because we had strong and fast policy reaction. I think US policy looks very good in a global comparison. You will never know exactly what is the causality of outcomes, but I dare say a lot of what has happened so far is effective policy, fast, and policy that wasn't too small. Is there a CapEx meltdown? I would say the numbers actually beat expectations, particularly if you look ex-transports, as in the top panel in the second column. Looks a little more dire if you have the total picture for durable goods orders. But even there, I would argue this beats expectations at this point. Quite a lot has been said the last week about the unemployment figures. More so than the continuing claims that were great, or a great fall in continuing claims last week, a little disappointing today. I think what's really standing out here is the share of temporary unemployment. If you look at the top panel in 2008, layoffs were layoffs and they were permanent, and now 80% have an entirely different intention. I think that matters. And then finally, the firm death picture. The big wave of real economy bankruptcies has not arrived yet. So we see an uptick. It's not even cyclically at highs at this point. I think it will go higher, But again, I think there's something to be said about the big push of policy, the massive liquidity injections, the protection of balance sheets, not letting going concern businesses fail because it makes no sense to do so. And so I think this is another reminder of what policy can do and is doing. And I think obviously not a moment in time to call the end to this story. There's tremendous risk in real economy balance sheets. But certainly the expectation was for worse than where we are right now, in my eyes anyway. So this is again V versus U. The battle over the shape is ongoing. Policies fighting that battle for us. I think there will be a downshift in the growth path. So some U shape is almost guaranteed. You're not coming back entirely to your old growth path. But the drop from your old growth path, that distance, that is what's being fought over. And I believe that fight is very interesting to watch and not a bad fight as it looks today. Now, let me move on, I think, to the last vertical that I had promised on the post-COVID world, which is more about behavioral change, the microeconomics, moving on to households. If you go next page, please. Sort of a cartoonish summary of what we're thinking about. So obviously we're all doing things differently than 3 months ago. The question is, are any of those changes going to stick? So Megan mentioned us working from home and you know, we all do that. Will we continue doing so after on the other side of this? And that cascades through virtually all sectors, and the permanence question is the key question. What I find most interesting from a macro angle, so using micro to answer a macro question, is are we seeing a accelerating rate of digital adoption that is going to stick? And is it going to be truly impactful? And particularly, can it be impactful in the services economy, which has lagged behind the physical economy in terms of productivity growth for so long? So this is, for me, the key question if I look at the micro foundation of macro performance. And I think there's a picture on the next slide, which I want to talk about briefly. Here is a long run view of the US economy dating back to 1952. And it shows you the share of different sectors in the US economy. And the color codes tell you the productivity performance or productivity growth in a given year in a given sector. And I think what you can see here quite cleanly is that the goods economy, the top layer there, is shrinking so much in terms of weight in the economy, but it was pretty decent productivity growth, relatively speaking. So that's automation, etc. The bottom part of this picture is your services part of the economy, which is growing in share, but it's all red because productivity growth used to be and has been that much worse. So in a way, we're living in a bad mix shift where, you know, the bright spots of technology and productivity growth are not happening in the growing part of the economy, they're happening in the shrinking part of the economy. And so if COVID-19 is a credible catalyst where you're cracking open, you know, financial services, education, healthcare, and you eke out 10, 15 basis points of productivity growth there, that's nothing to be scoffed at. That's not a, you know, step change in what we can expect in terms of trend growth and TFP growth being lifted massively higher. But I wouldn't ignore it either if there's a credible argument to be made that some of those changes are sticky and actually manage to lift some of these sectors to a higher productivity plane. We can discuss which sectors those are and which ones are suffering, perhaps in the Q&A later. I think at this point, I just want to close with a summary view of how to conceptually frame everything I've said. I think the next page has that. There is a reminder of the 3 verticals that I walked you through. Sort of the big regime breaks is the first pillar, the structural damage in the middle, and the behavioral change on the right. And then horizontally are sort of the layers of the economy, moving from macro all the way down to households, the micro level. Sort of in my research, I look at all these intersections. I work with large corporations on what does it mean for their business models. And I think each of these intersections has something truly interesting in this massive crisis. Obviously, none of us imagined 3 months ago that we would ever have all those detailed conversations. And with that, thank you, and I pass back to Don.
Okay, thank you very much, Philip. And now we're going to move to our audience question and answer session. I'd remind our attendees that you can enter your questions for our speakers under the questions tab on the dashboard. So as we stop to compile some of the questions, maybe I'll start out with a question for Megan. First, is this a demand shock or a supply shock? And what do you think that means for inflation if we consider that long run rates or tips are not indicating any higher expected rates of inflation at the moment?
Yeah, so I'm going to give you a typical economist answer and say it's both demand and supply shock. But right now, the demand side shock is clearly overwhelming the supply side shock. It began as a supply side shock when the virus was only in China, and all of a sudden companies had trouble getting parts. In the US, Amazon orders were delayed. But once it spread and we chose to put our economies on a deep freeze in response, it became an intense demand side shock. Now, demand side shocks are deflationary, supply side shocks are inflationary. So in the end, which one's going to win out, I think is the question. And as we're reopening, the demand side shock is abating, but I do think that, there is a supply side shock that most of us aren't appreciating. For example, am I not going on a holiday because I, can't, or is it because, I've been laid off my job and I don't have the money to? I think that is the question you need to be asking, and it's different for different people. So if there is a supply side shock, we could get some inflationary forces. No, I, like Philip, am not worried about inflation at all. I also think we've learned that, a lot of us are managing to be productive with fewer resources. And so off the back of this, we could end up with some productivity growth, and that would also generate some inflation, a good kind of inflation. I think that's possible. But even if we got a bit of inflation, it's worth pointing out that major central banks have missed their inflation targets for the past decade, roughly. So actually getting a bit of inflation wouldn't be so bad. I think the Fed would be the first to celebrate. And also, given that we're spending so much as a response to this crisis, one way to get out from under a massive debt burden is to inflate your way out from under it. So a little bit of inflation could actually help a bit. What I think some people are worried about is, a huge jump in inflation that causes central banks to respond and hike rates. And that makes borrowing costs unsustainable, and then deficit financing is a disaster. I don't think we're looking at that. Some people will point to World War I and World War II and say, well, we had, a huge amount of inflation off the back of those, and this is kind of like that. And I would say this isn't like that at all, in part because a lot of things were destroyed during World War I, World War II that had to be rebuilt, and that was a way of generating inflation in the real economy. That hasn't happened this time around. We're not actually having to rebuild a bunch of capital. So the inflation we're getting is in asset prices, but it's not I don't think it will really be in consumer prices. And again, when we had QE last time around after the last crisis, people were worried about inflation then, and we only saw it in asset prices. I think we can probably expect inflation to remain fairly muted in the aftermath of this.
So could we follow up on that, Megan? Are you worried about a disconnect between the economy and the stock market here at the moment?
Yeah, so yes and no. It depends on what your narrative for that is. So if you think that the markets are expecting a V-shaped recovery, then yes, I'm worried about that because I don't think we're going to have a V-shaped recovery. That being said, I don't think that is the right narrative for why there is this seeming disconnect between the markets and the macro picture. I think it's driven by a few things. One is, the old adage, don't fight the Fed. It's no coincidence that the equity market rally started the day after the Fed announced its corporate bond buying. So I think, equity investors felt protected by the Fed, feel like the Fed has their back, and equity dividends are higher than yields on 10-year treasuries at the moment. So that it makes a lot of sense that investors would pile into equities. So that's the second adage. There just isn't any other good alternative that will get you higher returns if you're looking for a safe haven asset, a US dollar denominated asset, as a lot of investors are right now. And then I think if you actually disaggregate most of the major US indices by sector, it's the rally's really been driven largely by the FANGs, Microsoft, and healthcare. The FANGs have a 25% weighting in the S&P 500. Healthcare has a 15% weighting in the S&P 500. So they're driving this. It's broadened out a little bit, the rally, since the beginning, but it makes sense that investors would actually bet on those companies in the face of a crisis where we're all having to work from home and do webinars over the internet, and where we're all looking for a vaccine or some treatments for this virus. So that doesn't really worry me that much. So I think that there are a few different factors. It just depends on the narrative. If you think it's because investors all believe in a V-shaped recovery, then it's a problem. These other factors, I think, make rational sense, though.
Well, thank you. For Philip, then, you mentioned that you don't think inflation's a concern and you're comfortable with where the currency sits. How does this become worse from here? Do you have a worst case scenario that worries you?
Yeah, I think I think a lot of it rides on the policy response, right? I think it will take some time to just figure out how impactful it was, but I believe a lot of it is working. So what gets worse from here, potentially, hypothetically, is where the consensus around policy falters. And this is an election year, and I'm not at all saying this is my base case. But if I had a worst case scenario, it would be one where the reopenings are not successful. You get a very nasty second wave, you move into election season, and somehow suddenly COVID-19 response in the policy space becomes politicized. So it becomes a political football instead of a rare moment of bipartisan consensus and fast and solid action, what we saw in March. And so, if you have that kind of scenario where the political underpinnings of the policy response falters, then yeah, that's the worst case scenario, and where I actually believe you could move into something that is a structural break, the kind of scenario that I tried to play down earlier. But again, it's not my base case scenario, so it's a true worst case scenario.
And then, Philip, we have a couple questions from the audience about the service sector, and discussing that if we have an increase in productivity, the offset could be we have fewer jobs. Does that worry you? Are there certain sectors you would focus on? And do you see a long-run endgame there?
Well, I mean, this is a long-running debate on whether technology kills jobs. History doesn't always suggest so cleanly at all. A lot of people moved out of agriculture, and yet, we found new ways of employing them. Productivity growth means that wealth is created somewhere. It has to go somewhere. It doesn't leave planet Earth, so it's going to be redeployed somewhere. It's going to create demand for something. By and large, I'm not a big fan of the hypothesis or the assumption that productivity growth must lead to mass unemployment. Does it require careful reskilling and maybe government intervention to do that well and accelerate that, something that European nations are a lot better at than the United States? Yeah, I think there's a case to be made for that. How do governments, corporations work together to reskill and create the supply they actually want, the labor supply they need? How do they actually create that? That is something that happens dynamically in other countries, happens a little differently in the United States. I think there are hiccups and challenges, but by and large, sort of the apocalypse of mass unemployment because of technology is not really my core narrative for productivity growth and technology.
Okay, thank you. So the next question we have here gets to some of the issue with where workers locate, whether it's downtown, whether it's remote. And so let me open up the discussion for some conversation about whether we think urban cores will be able to bounce back from this, or is that a pressure area, and how long does this type of adjustment take? So maybe Megan, if you had some initial thoughts about how that could happen, and maybe being around the university setting, what role universities might play in the context of these urban cores.
So I think that urban cores will have difficulty bouncing back the same way that they were before the crisis. I think there already is an exodus to suburbs. I know we're experiencing it in Boston. Most other cities are as well. So I think, that will change. Partly as we can work from home, but partly as people just don't want to be in the middle of a major city in the face of a pandemic. What role can universities play? I think the university system is pretty challenged on its own. We're not reopening at the Kennedy School in the fall. The revenue streams for universities are pretty buggered at this point, particularly given that the business model is to bring in international students to pay full whack, and now no one can travel. So I'm not sure that universities are going to be the ones to step up and play a big role here. I think they've got their own challenges.
Philipp, did you have any thoughts on urban cores? Urbanization versus elsewhere?
A few spontaneous thoughts. I mean, I can see the exodus. I spent February, March, April, and May on the Upper East Side of Manhattan, and there weren't a whole lot of people around, and I certainly see that narrative. That said, though, on the other side of this, and there will be that moment when COVID is the past, my expectation is that a lot is going to look like it looked pre-COVID. I'm not convinced that cities and urban centers become less attractive. It's not a perfect analogy, but think about what happened to air travel after 9/11, which was sort of an existentialist shock to the industry and to that way of life and how mobility worked. It was a massive shock. It necessitated regulatory changes, TSA, etc. So we changed processes around doing this particular part of our lives. But then it bounced back, and you had a massive growth wave after 9/11, strong growth in the aviation sector, strong passenger number growth, etc. Again, obviously not a one-to-one analogy, but I think there is a theme generally in COVID-19 and how we think about it, that the intensity of the moment is so overwhelming that it's very tempting to draw a straight line from the here and now, the tactical, and let that impact our strategic thinking of what the legacy of this must be. And so I'm erring on the side of continuity with a lot of this, as bad as it is, and as badly as that might turn out, that kind of perspective. But on many topics, I think continuity is underrated, notwithstanding just the bad intensity of what we're living through.
Well, thank you. So we have several questions on how forecasts might change if there's a second wave of the virus. So maybe, Philipp, we can stay with you, and if you have thoughts on that type of scenario.
Yeah. I think if you have a second wave of the virus and cases and deaths, I think the assumption often is that we will then automatically go into a second lockdown the way we had it in April. And I'm just not sure that's the right assumption. I think more likely you would see in the United States a national muddling through in that case. I mean, recall why the lockdown was so all-encompassing. Because there were dire fears around hospital capacity and the real prospect of, cases and patients spilling out into the streets. And as long as that fear has come down and there is confidence that you can avoid that, and I think the experience probably points in that direction, I think the political class will decide that you muddle through even if you see cases flare up again, even if it's quite bad. So I think this was sort of my base assumption. This is sort of my hunch of how this will play out. And then if you don't have a full mandated lockdown, I think the consequence of that is that the impact on growth and the damage structurally I talked about with capital stock formation, all of that then is not as severe as if you, force everything into another full-blown lockdown. So I think nobody knows, I don't know, but my assumption is that you'll muddle through and that will help economic performance.
Megan?
Yeah, so as I said before, I think that confidence is everything. And I also think we will absolutely have a second wave and are probably starting to see the beginning of it, right? We've had massive protests in every major city and most minor cities. There's no social distancing involved in protests, so I don't really see how we avoid it. I agree. I also think we probably won't go into a full lockdown, but if there are more restrictions imposed, I think that that will raise the uncertainty for people about whether we ever will go into a full lockdown or how much of a lockdown we'll go to. And I think that will cause people to decide, you know what, we're not going to go out and spend. So just as, you know, if you dropped a big bunch of money on me and said go on holiday, I wouldn't buy a flight right now. I think, you know, it's going to require people feeling comfortable to go out and know that going to a nightclub won't land them up in the hospital for spending to go to anything close to what's normal. So I do think that that confidence piece is the key. And if we have a second wave, that will be pushed. People regaining confidence will be pushed further out. And so that will just make this a longer, harder slog.
Okay, we have a follow-up question here. While COVID-19 and other viruses before this did pass, we'll probably have COVID 20, 21, and 22 after this. We saw permanent changes in behavior post 9/11. Would you expect long-lasting changes such as social distancing, which will impact high-contact businesses, the gig economy, or leisure and hospitality, concerts and sports? And so if it's not a second wave of this, but say a similar issue in relatively short order, is that an additional problem for the forecast, or do you think we've adapted? And maybe, Megan, I'll start with you there and then go to Philip second.
Yeah, so I mean, every epidemiologist I've spoken to has said, you know, when we get a vaccine for this one, don't feel too comfortable because we will absolutely have another pandemic that's coming. Will social distancing become normal for us? I don't think so, actually. I think we'll end up waiting until we have the next pandemic and then maybe just having a better idea of how to respond. Maybe build in automatic stabilizers for our policy response so it can be faster, so we can sort of mitigate the downside a bit. But I don't think we're going to be social distancing forever. Could the gig economy and these high contact industries be permanently hit by this? Yes, I think we saw also after the global financial crisis that there was quite a lot of scarring. You saw it in things like household formation, which took forever to come back. I do think that there will be scarring after this crisis, and that will change our consumption patterns a bit. And it could mean that, you know, in urban cities, people get electric scooters instead of taking Ubers, or, you know, I'm not sure what the shift will be, but I do think that those sectors are vulnerable.
Philip, do you have any thoughts on an additional virus pandemic?
I think I broadly agree. I think, look, the sharing economy was very cool, and now it's not so cool. And when this is over, it will gain more attraction again. I think the question you read, Don, had a premise of there will be more pandemics, there will be more viruses. And while I'm in no position to judge that, I also noticed that we never spend serious money on perfecting the machine and research of finding vaccines and cures, etc. And suddenly, as the cost is in the many trillions, I think we'll also see a greater readiness to invest in prevention, speeding up the process of finding cures, building antibodies, and building the supply chains, etc. So I don't want to play the eternal optimist, but I do think one legacy of this is going to be a strengthening of our capabilities to address such crises in the future, hopefully. Maybe not at the institutional level, which is sort of globally damaged, but certainly in the private enterprise space, there's a business case now there, also a powerful one for being a lot better, a lot faster, a lot broader in this space. And so, you know, I don't think that necessarily will have COVID 21 and 22 as the question phrased it. I just don't know that to be the case. So it's not my base assumption.
Okay, thank you. I think we have time for one more question, and maybe I'll try to combine a few here to talk about the Federal Reserve and their response for just a minute. So there have been many moves. The Fed has intervened in the investment grade credit space, the high yield credit space, as well as many other places. They're also getting involved with the Main Street lending program. And maybe Philip, I could start with you, and then Megan, do you have any opinions on what the Fed's doing? Do you think their programs are working in concert? Do you think there are any hiccups that we should be watching for?
Yeah, I mentioned it earlier when I talked. I believe that certainly in terms of policy attitude, getting it done fast and not thinking too small. Those are the two biggest drivers of confidence in the space. And then the political backing for it on the fiscal side. But you asked Fed, so I'll keep it to monetary. I mean, I think that was convincing in my mind and compares favorably with Europe and other geographies. So to me, when I showed the bankruptcy numbers, when I showed some of the other numbers that I feel actually beat expectations, I put a lot of that down to that policy response. And so I think that's actually going well. That's a silver lining when obviously policy effectiveness is a perennial question mark over the last 10, 15 years. Clearly, we have to be ever more aggressive with policy, but it's being done, and I believe it looks like it's working to some extent.
Yeah, it's hard to overstate the distance the Fed has moved in a really short time. Just a couple of months ago, I asked some Fed officials if they'd ever consider buying up corporate debt, and they looked at me like I had 40 heads, right? And now they're buying up investment grade and high yield corporate debt. So I think their response has been appropriately swift and big. My worry is only that, and I should also say, I think it's been successful in that the kinds of market dislocations we saw in March, which were truly scary, seem to have been dealt with. There don't seem to be those dislocations in the markets anymore. I guess my concern is only that the Fed has provided a ton of liquidity. That's its job. So it's addressed a liquidity crisis. But what can it do about a solvency issue? And there, that's not really down to the Fed. So for companies that needed liquidity, the Fed has done its job. But for the insolvency issue, I don't think that the Fed can really help there. And that's just starting. And it was in Philipp's slide, but we've just seen the beginning of bankruptcy filings. And I think there's a whole massive wave of those coming down the line. Not just from shutting down the economy. I think there will be another wave when we reopen and firms realize that demand isn't actually what they had hoped and they don't really have a business model anymore. I think a lot of industries are going to have to restructure, a lot of firms are going to have to restructure, and a lot of them just aren't going to make it. So I am worried about the insolvency issue and the implications of that for banks. When I talk to investors, most of them say, well, it's okay because the Fed does stress tests, and so this must be kind of like the worst case scenario in those stress tests. This is way worse than the worst case scenario. So I think that there is some complacency on that front there. So I think the Fed's done a good job, but it's not the Fed's job to address everything. And I think there are some of these issues that we still need to watch out for.
Well, Megan, Philip, thank you both for a fascinating discussion and for spending time with our GIC community. A note for the audience before we close, on June 18th, we are hosting a fireside chat with Loretta Mester, the President and CEO of the Federal Reserve Bank of Cleveland. Registration is available on GIC's website. That will be followed by part 2 of our series titled The Disease and the Cure on June 24th. Finally, a feature of the David R. Kotak Global Healthcare Series is Mr. Kotak has established a very generous matching donation challenge. Through July, any donation made will be matched dollar for dollar up to $50,000. In other words, your donation of $200 becomes $400 in value and impact. All donations will go directly towards bringing high quality content as a public service for the remainder of the year. To learn about membership or to take advantage of the donation match, go to GIC's website at www.interdependence.org. And as we conclude, I encourage you to take 60 seconds to respond to our audience survey to let us know how we can improve our programs. Your feedback is important to us. Thank you for your attention and good afternoon.